Because we haven't really addressed one pink elephant, if you will, about referral programs. And that is there's that notion that it's all about money. Someone is only going to refer you your business, your offering, if they get paid. And what we found is that when we take the time to understand the skills, willingness, and opportunity, and we've also done primary research on this and also secondary research as well. We did a study that had over 600 organizations across North America. One, we found that money was often not the key motivator for referring, but rather there is a cluster of motivations. There are several things going on at once, and it evolves over time.
Welcome to the latest episode of the Raise&Exit podcast. And as we continue a theme of ours in having guests who have been along for the ride in helping companies go and scale to either their next raise or be able to set their business up for a successful exit, today we have Andrew Brown as our guest, and he comes from a very different way of going and adding revenue to your business, which is actually formalizing a B2B referral model. View this as a way to learn from Andrew on how to go and approach channel partnerships, other service partnerships, etc., especially as the human connection becomes even more relevant as AI is changing the go-to-market narrative on a monthly, sometimes weekly basis. So on that note, Andrew, welcome to the Raise&Exit podcast. Maybe expand a little bit about yourself and how you kind of got into this domain that you've been diving into so closely the past few years. Andrew, over to you.
Edgar, thank you so much. And thank you everyone for spending some time with us today. Yes, I'd be happy to take a minute or so. So for over 30 years, I've worked in professional services, software as a service, digital marketing services, all with the goal to help companies grow by increasing revenue. And as a result, I've held a bunch of executive marketing, communications, business development, and sales positions. And during this time, I've written articles for the Financial Post, Canadian Business, Profit, Globe and Mail. And what I've done is I've worked over the years with tools to optimize every stage of the sales cycle, particularly generating leads and qualifying leads. Because we know that having a good process in place really helps an organization be able to grow and act more efficiently. And I consistently found that new good quality leads were coming in via trusted referral sources. And that probably isn't a surprise for a lot of our listeners. And what was it was happening in parallel to sales and marketing initiatives. But I also found that organizations leverage referral sources in ways that had real negative consequences, like overusing referral sources or neglecting or disrespecting them. So that meant businesses lost existing customers. It meant they experienced reputational damage when referral sources weren't representing a company well. I knew there had to be a better way, a game-changing way of harnessing referral sources' energies and enthusiasm while avoiding the business downsides. While I was working in a whole bunch of organizations, I started testing different methods, and I found a great way. Again, I call it a game changer because it's turned in impressive business results as a way to harness referral sources and make them successful so that organizations can grow.
I really appreciate that context, Andrew, because I think what a lot of people kind of forget is how long it takes certain types of marketing programs to become formalized in the business ecosystem, because they're frequently kind of hit our mind share when they've actually hit a certain momentum, critical mass, or both. And as you're talking about this, it's reminding me of like how we've gone from, hey, like podcasts of like, hey, this is kind of novel, to everybody's starting to go and want to be a podcast guest, to now there's actual companies globally that go and facilitate a matchmaking service, is kind of like Tinder, but for podcast hosts with podcast guests. Maybe we don't have the same swipe right, swipe left dynamic to it, but the same applies, I would say, to other dynamics that is there. Like I even take a look at how technology companies go and have managed service providers. And the piece that I'm very curious about, and I think you almost started alluding to this when you're talking about the reputational damage, we've done a lot of evaluation at Avasta on the professional implications of it, right? Where managed service providers or formal channel partnerships kind of get abstracted. Right. And they start talking about, well, we have 1,800 MSPs that we work with, or we have 63, partner organizations. And I'm curious to know from you, how do you prevent that dehumanization almost of those relationships while balancing the fact that you do need to use numbers and dollars to articulate these programs? What's the guide that you would go and give to founders, to business owners, in not just from a B2B referral point of view, but the aspect around preventing dehumanization of your partner ecosystem?
Oh, man, that's such a critical question. And I'm not sure if I'm going to be able to really dig deep into this, but I will suggest a few things. The difference between a managed referral program and a channel program is seismic. They are distinctly different, and yet they get put under an umbrella of business relationships or perhaps strategic alliances. But the foundational assumption for channel partner programs is scaling first. More is better. We've got to scale. Scale will equal growth. Managed referral program says, wait a minute, what's important here? Is it scale or is it growth? And it turns out that most organizations want growth. And growth can happen without scale.
So let me ask them, because what the image that I have in my head, and I look at this right from the statistical data shared by companies I've worked with, right? If you go and have that, call it the volume play, you're pushing the volume to go and find out who's going to be your top drivers. Like it ends up following a very standard statistical distribution where you go and have like 50% of your revenues coming from actually single digits of your channel partner relationships. But
correct.
What I'm hearing that you're alluding to, and maybe this is kind of me nudging you because out of my own personal curiosity, not just on behalf of the listeners, it sounds like it's that nurturing and curation. So it's a smaller volume of relationships, higher touch, but as you alluded to in your introduction of yourself, also making sure that you don't exhaust the equity that you have with them. So maybe kind of follow that pathway. And I have zero interest in this myself, not at all.
Okay, so let me throw something out at you. I'm glad the discussion sort of stems partially from the notion of channel programs, because in fact, I just saw some research the other day where 83% of organizations that run channel programs are very unhappy with the results. And a huge percentage, over 60% of them as well, the perception of the channel program is that it's not doing well. So not only is it not delivering, but the perception of the program is not delivering. The channel program is, I know I may be oversimplifying, but particularly when you are trying to achieve growth through scale, the approach is very much a one-size-fits-all, that dehumanization that you were speaking about. With a managed referral program, it hits on exactly what you were speaking about, Edgar, and that is the importance of relationships. So the process involves identifying the right referral sources, applying a discipline to evaluating them, realizing that you can grow with a half a dozen people who are well identified, well honed, and here's the key thing, supported by organizations. Because typically, when it comes to our referral program, the approach to referrals is kind of loose. It'll happen, right? It's the cross the fingers approach. It's ad hoc. And if something does come in, you grab it because you're so grateful that a referral source has brought you some referred business. And that might be crappy business. And by crappy, I mean not on target. It might be not profitable. It could be bad reputation. It could be bad for your reputation. It could be business that where a referral source who hasn't been managed well has misrepresented you, unfortunately. And so an engagement can start off very poorly because the referral source has misrepresented what you can and cannot do. So the discipline around finding, harnessing, and supporting referral sources is different then. And it starts with a foundational difference. This is where it breaks off from channel programs. As I said, it is growth over scale. That's one foundation. The other foundation is how do we make referral sources successful by understanding, and these things evolve, right? Life isn't simple. It's messy. It means understanding referral sources' skills, willingness, and opportunity to refer business to you. And no referral source necessarily is going to have all that great goodness out of the gate, bringing you a business that's right at the bottom of the sales funnel. You're going to have to work with them to identify the gaps and say, Edgar's got great skills. He's got great opportunities, but why is he doing this? And getting Edgar involved out of the gate may very well be different 6 months down the road when Edgar's in a different position, either personally or professionally.
I like where you're going. I like where you're going with this, Sandra, because there's like going back onto my thing about like managed service provider programs or channel partner programs. Yeah. You're trying to find where that fit is, but you're actually just selling a product for them to go and have on their shelf to sell when they're looking for, versus what you're looking at here on the higher quality side. This is actually going and taking a look at what I call like a win-win-win dynamic, which is I win, you win, the mutual opportunity, mutual client wins.
Exactly. And speaking about that client, the referred business that comes in, clients are smart.
Yeah.
Right? They know when a channel reseller, when they do bring them opportunities or make a recommendation, that they're doing that in part because the channel partner, is benefiting from that process, right? They know that they're getting a commission or they're getting a slice. They're getting something.
Yeah.
And the clients, by using a channel program, you actually end up, over the long term, create very skeptical clients because they start to wonder, why is a channel partner bringing me this solution A versus B? Oh, it's because they get paid more for A. So you create that skepticism versus, again, if you harness the right referral source, they're bringing referred business to you at the point where the referred business, the client, the organization is ready to buy. So they've already qualified it. They've already qualified it. They're not even thinking about competitors anymore. So you don't have to worry about that. So the acquisition costs are just sliced dramatically. And the speed to conversion is fast. With our clients, we find that when the referred clients are being brought by the referral sources, it's a 90% plus conversion rate versus a marketing campaign, which is probably between 2 and 12%.
That is so good, because what you're talking about is one of the things that I see as a big issue in a lot of kind of ROI calculations, because people are going, well, I have my ARPU, average revenue per user, or I have my ACV, annual contract value, or average contract value, depending on which A you want to go and use in there. But what I would say you're alluding to here is, and this is what I'm a big fan of, which is the kind of the total ecosystem cost, right? Yes. So it's return, like it's revenue per attempt.
Yes.
Right? Versus revenue per client, right? And then what it forces you is, what I look at is like net customer lifetime value. If I look at it, it's like, well, if I start my customer lifetime value calculation only from when they become a customer, my customer lifetime value calculation looks really, really good usually. But if I go and do net customer lifetime value of how many at-bats did I need, pardon the current baseball analogy because we got World Series going on, what you're pointing to is, if you're doing it right, you can get to lower at-bats.
That's right.
Greater conversion ratio. It means your net customer lifetime value is actually higher.
That's right.
Because your cost of upfront is better. So build into that a bit for me.
You're right. And I would just add one more component. When a client comes in through a managed referral, they are likely to be a client longer, and they are likely to spend in the order of 25% more. That just contributes to that calculation you go in that you make when it comes to determining what a lifetime value is.
I think that's so great because you now need to look at go-to-market program versus go-to-market program versus customer acquired per program versus customer acquired per other program. And that really resonates for me. So I want to go back to like the theme of Raise and Exit, which is providing the knowledge and insights that founders need months or years in advance of fully realizing the benefit. I look at managed service provider programs. They take months, sometimes years to kind of get to their full fruition. Right. You're talking about a scale of activity that is smaller in relationships, but is it any different in workload or time to monetization? How can you manage that? How far in advance of wanting to display that your managed referral programs are working so that you can use that as part of your strategic planning?
That's perfect. A managed referral program, first, it's important to keep in mind that it can run in parallel to sales or marketing initiatives. You can measure it independently, and they're silly stupid to measure. So it's really a good idea to run a pilot project. Having said that, managed referral programs can be up and running. They're completely technology agnostic. So it's not dependent on technology. They're not change management programs. So you don't have to worry about the internal resistance or standing up huge new processes. A program can get underway within a matter of weeks, and you will see results within 1, maybe 2 quarters. It's usually before the second quarter.
Just had an aha from what you went and said there, because this is a B2B related conversation fundamentally here. I think a lot of people are forgetting from the perspective of the buyer how long it takes to buy something versus from, I would say, the historical bias from the seller, which the tracking typically begins from when they've qualified the opportunity. Correct. And there's a huge time disconnect, right? Somebody could be buying for 2 years, but the seller is only selling to them for 6 months. What you're kind of pointing to is that the ability to bypass a lot of the qualification process that is there through this. And I think the other dynamic that kind of emerges from me is that, and this is something a lot of salespeople, founders, business owners struggle with, which is, how do I know this is going to go and work? The reality is these are all calculated bets. And I think what you're pointing to is that you need to go and do that assessment for yourself. Is your business going to scale? Is it scalable using a managed referral program? So what would be kind of like your top 3 to 4 questions that an organization should be able to answer for itself before making an investment into exploring or establishing a managed referral program alongside other sales and go-to-market channels?
So a couple of things. First, I do want to emphasize that scale is not the focus. Growth is the focus.
Okay.
So I would be asking an organization, how ambitious are you? What are your targets for growth? And we found that those organizations that want 25% annual year-over-year growth are more open because they want that growth. They don't really care how it gets there, but they want that growth. The goal, and in fact, when we sit down at the very early stages of developing a program, we start with the goals. How much new business do you want? And how much of that do you want from referral sources? So that becomes an integral part. Now, you talk about, I'm going to paraphrase and set me right if I'm wrong, about readiness. Is it the right time? When should I consider a referral program? So I would go back to, again, how ambitious your goals are. There is a process that we take organizations through, which is a referral readiness, because we won't actually recommend anyone launch anything until they are ready.
Yeah.
Because we have our guarantee at Bridgemaker Referral Programs, if you don't mind me advertising a little bit, is that we guarantee more referred business and higher value referred business. So we won't even charge you if we don't deliver. It's never had to happen because we apply a discipline that means that we can succeed when we make that promise.
I appreciate you going to put that in, because I look at a lot of the kind of, again, that notion of abstraction in terms of looking at different programs, right? Like I look at organizations going and saying, well, I allocated 30% of my marketing dollars towards AdWords, another one towards search, another one towards digital display, whatever the heck it may be. And they're always on okay, we got to spend the money to be able to figure out what the reversal is. Same thing with the MSP program. It could be, funded MSP, right? So you're wanting to be a top 2 or top 3 endorsed vendor through an MSP. And I've done lots of work with that through clients and partners over the years, which is, you could go and have 20 different players inside a space. It doesn't make sense for the MSP to go and use more than 2 or 3 because they have their own sunk costs of their own staff.
That's right.
Providing that technology. And I think what you're pointing to in a managed referral program, this is more of a symbiotic relationship of, hey, you both win in this situation. It needs to be a complementary offering and be able to go from there. So I appreciate where you're kind of taking that direction. So let's say that you have that managed referral program as a legitimate pathway to explore. What are the kind of top 3 things that need to be in place to provide that legitimacy so that people know what needs to be in place for a managed referral program to be a revenue generating, growth generating alternative or complement to go to market?
Sure. So there are a few things. Again, we go through a deep dive readiness assessment with our clients. But one thing that's really important is something that all organizations should do anyway, but sadly they don't. And we can help them do this. And that is quantifying your reputation. And there are a number of different ways with which to quantify reputation. You can take a look at employee surveys, and that reveals how good you are as an employer. You could take a look at customer satisfaction surveys, because that helps give a measure of are you keeping customers happy? You could take a look at sales over sales growth, because that shows how quickly the market's embracing you. All these things come together to help quantify a reputation, because when you've got a managed referral program, you are going to be arming your referral sources, the ones you've evaluated, with the tools to represent you, and you owe it to them.
Yeah.
You owe it to them to be really concise as to the real nature of your reputation, because they're repping for you. Why would you not take that time and quantify your reputation? And again, there are a number of different strands, and it doesn't have to be at day one. Organizations can take a look at how they're being talked about in social platforms. I mean, that is a very simple, a quick litmus test to see how people are talking about you. Take a look at customer support. What sort of feedback, what's coming from the daily or weekly reports from your customer support as to the feedback people are saying. So again, that's a big one to help quantify that reputation. And when you have that authentic discussion with your referral sources, it does really help strengthen that bond with referral sources. They know you're not perfect. No organization is. But you coming to the table with a real sense of your reputation demonstrates that you respect your referral source, that you want to involve them, that you're not trying to obfuscate anything. So that's a big piece of the readiness.
So you talked about at the beginning around, you also got to be responsible when to use a managed referral program versus not. And I would presume kind of pure play, low cost software solutions, not using a managed referral program. How do you as a business kind of qualify when this is relevant? Is this ticket price? Is this revenue model type? Is it ecosystem of who you're trying to sell to? Just so that kind of our listeners can figure out how to best take advantage of this notion of a managed referral program.
So managed referral programs, the principles can be used B2B and B2C, many of them. However, what we do is we work with organizations whose average receipt or offering or subscription is in excess of $75,000. And the reason why we do that is because our engagement is a fraction of that.
Yeah.
So that all you have to do is get one great referral to cover the cost of our services.
Yeah.
And so that's an easy calculation. But managed referral programs can be applied across industries. We've worked with the better part of 15 different industries in helping companies harness referral sources. And one thing we haven't necessarily addressed specifically is the speed. Again, I think I touched upon getting customers through the funnel is cumbersome. And you were talking about the full length of the sales and the purchase process when calculating lifetime value. let's face it, if the sales cycle is long, all those resources that are sunk into sales, right? To build a team, to develop content, to go out and try to sell using a number of different programs. That's costly.
I love where this is going, Andrew, because the way that I look at it is I hate using gross dollar costs or gross dollar revenues for anything. I always go and take a look at like what's that breakdown by time.
Sure.
And I think what you're pointing to right there is like, hey, going back to what we were talking about, customer lifetime value versus net customer lifetime value. Previously, this is the same thing. So if, hey, let's go and take a salesperson from when they first start doing outreach or getting an inbound opportunity. In fact, if they're getting an inbound opportunity, what was the role of marketing cost in getting that inbound opportunity? And you just go and put them onto the same line, and you go and say, okay, what is my cost? So my arrow is going down as my costs are coming per week, per month, per activation, versus when that revenue is coming in, and then taking a look at it from that time value of money point of view. Now, as you're very rightfully pointing to, and I think this is why I want to avoid that risk of people going in and saying, oh, this is the new magic bullet that's here. I'm going to go and get a managed referral program because it's going to be, so quick. I can get revenue within 3 months. There's actually a cost of infrastructure or market presence that you need to go and have or invest into that relationship, which is different than investing into a salesperson that might be pursuing dozens of opportunities at the same time. So that's kind of what I'm getting as a takeaway from here is again, you got to do that time series work.
Correct.
Okay. So that's very helpful. I'm glad that I'm picking up on kind of that apples to apples ability to compare.
It just helps that you're so much smarter than me. So I appreciate it.
It's just how my mind works, but like that's what I'm kind of going and seeing here because I think this is the big problem that is there. Like we're working with a company right now, and we're just going and taking a look at it from a capital cost point of view. They're like, well, hey, I want to go and invest $500,000 into option A or option B, and my brain just goes straight into it's like, yes, but when you spend that money versus it starting to pay itself back for you are two very different time periods. You're viewing the same outlay. I'm trying to figure out when do you have an expectation of the inbound coming back for you. And I think this is what you're kind of pointing to is like the fact that you're saying is don't just jump right into it, determine whether it's valid for your business model and at the life stage of the business that you're in.
Right. And actually, I'd like to point out one other thing because we haven't really addressed one pink elephant, if you will, about referral programs. And that is there's that notion that it's all about money, right? Someone is only going to refer you, your business, your offering, if they get paid. And what we found is that when we take the time to understand the skills, willingness, and opportunity, and we've also done primary research on this and also secondary research as well. We did a study that had over 600 organizations across North America. One, we found that money was often not the key motivator for referring, but rather there is a cluster of motivations. There are several things going on at once, and it evolves over time. So if you're thinking, you know what, a referral program, we're just going to pay a percentage. No, we've had clients who actually the referral source got paid nothing. They wanted not $1, and they were very, very successful at referring very profitable business. What they wanted was they wanted to feel like they were part of something bigger. That was their primary motivation.
I love it. I think that's such a great close to this whole episode, Andrew. I really appreciate it. For guests that are there with the podcast, you'll find a link to Andrew's company, Bridgemaker Referral Programs. I think it's worthwhile for you to go and just see what he says in his public domain as well. Andrew, it's such a pleasure to have you as a guest today. And I walked away with something valuable for myself too.
Terrific.
Thanks.
Thanks.